What if I told you there's a silent thief lurking in your investment portfolio and it's on track to steal over $100,000 from you easily? The crazy part, you won't even see it on your statements. And Wall Street is counting on you never noticing. These aren't dramatic one-time scams. We're talking about seemingly tiny fees, sometimes less than 1%, that quietly bleed your portfolio dry year after year. So in the next few minutes, I'm going to pull back the curtain on the most deceptive ways Wall Street is secretly pocketing your gains. More importantly, I'll give you a simple checklist to spot these hidden charges and stop them for good. Because every single dollar you save in fees is a dollar that keeps compounding for your future. All right, here's the first one. Section 1, the hidden tax. Expense ratios first up, all right? The sneakiest of them all, the expense ratio. Think of it as a quiet annual tax you pay just to own a mutual fund or ETF. And it's dedicated to returns automatically, so you never write a check, which makes it dangerously easy to ignore. While a small fee is necessary to cover a fund's operating costs, many are just absurdly high. Here's where it gets painful. A 1% annual fee might sound like nothing, but its effect over time is absolutely devastating. That's 1% that doesn't just cost you 1% of your money each year. No, it costs you all of the future growth that money would have generated. A lifetime of investing with a 1% fee can devour over 25% of your portfolio's potential value. That could be hundreds of thousands of dollars gone, all because you owned a fund charging 1.5% instead of one charging just 0.5%. So how do you fight back? You become a fee detective. You can find the expense ratio in your fund's prospectus, or even easier, by just typing the ticker symbol into any financial website. For broad market index funds, you should be paying well under 0.2%. If your funds are charging you more than 0.75%, you are almost certainly being taken for a ride and need to find a cheaper alternative. Here's the other thing, the marketing fee, all right? 12B1 fees. This is a fee that is just infuriating. It's called the 12B1 fee, and you're not going to believe what it's for. Get this. You're literally paying for the fund to market itself to other people. That's right. These fees are used to pay commissions to brokers and cover advertising costs. The original idea was that helping the fund grow would lead to lower costs for everyone, but that hasn't been proven to be true. Instead, they often act as a hidden kickback, giving brokers an incentive to sell you funds that pay them, not the funds that are best for you. These fees are buried inside the expense ratio, so they're hard to spot. They can be as high as 1% a year, split between distribution and service fees. So how do you stop paying for their marketing budget? Look at the fee breakdown in your fund's prospectus. This is what you do. It's legally required to be there. If you see a line for 12B1 fee, that is a massive red flag. In today's market, with thousands of incredible low-cost funds, there is almost no good reason to ever pay this. Now listen, if you're getting some good value here out of this video and you're tired of Wall Street nickel and diming you to death, do me a favor. Hit that subscribe button. My whole goal here is to make this stuff simple so you can take back control of your financial future. All right, here's the toll booth, sales loads, and finally, we have Wall Street's version of a highway toll booth, the sales load. This is just a fancy term for a sales commission you pay when you either buy or sell a mutual fund. A, quote, front-end load is a fee charged the moment you invest. If a fund has a 5% front-end load, you invest $10,000, only $9,500 actually goes into your account. The other $500 goes straight to the broker right out of the gate. You've taken a 5% loss on your investment. That means your investment is underwater before it even had a chance to swim. Then there's the back end load, a fee you pay when you sell. It's often designed to lock you into an investment by making it expensive to leave. While some argue these fees pay for professional advice, study after study has shown that load funds don't perform any better than their no-load counterparts. The fix for this one is beautifully simple. Only invest in no-load funds. When you're researching funds on any major brokerage site, you can filter your search to show only no-load funds. Do this, and you guarantee that 100% of your money goes to work for you from day one. There is zero performance advantage to paying a sales load, so there is no reason to ever pay it. Your simple checklist and conclusion is right now. All right, let's wrap all this up with the checklist that you could use today. First, pull up every fund you own and find the expense ratio. Are you paying more than 0.75% for any of them? Second, dive into the prospectus. Hunt for those 12B1 fees. If you see one, it's time to make a switch. Third, check if you're in a no-load fund. If you see share classes with letters like A or C after the fund name, you're likely paying a load and need to investigate. These three things, high expense ratios, 12B1 fees, and sales loads, are how Wall Street quietly siphons away wealth from investors who don't know where to look. The difference between a portfolio riddled with these fees and one optimized for low costs isn't just a few dollars. It's life-changing. We're talking about the potential for a richer, more secure retirement. Don't let these hidden fees steal your future. Take these steps, do it today, clean up your portfolio, and make sure your hard-earned money is working for you, not for them. I'm Grant Stinchfield. Hit the like, hit the subscribe. Thanks for watching.